All right, welcome everybody. We are going to give it about a minute or two to let the room fill up. Several thousand people excited today to talk about tax law, which you can't say every Thursday in America. So this is a good day for us.
Who says you can't say that every Thursday?
I know, other than Jeff Levine, and no one else is probably saying that. It's just another day for Jeff. This is just another day. So welcome everybody. Very happy to have you. Like I said, we'll give this about another minute and then we'll jump right in. But very happy to have you with us today. Looks like we're already nearing 2,000 people that are going to be on with us live. Of course, this will be recorded, as pretty much all of our webinars are. And we will send that out once the webinar is over. So 30 more seconds here. We'll go quiet and then we'll jump back in and get things going. Thank you for being here. All right, great. We'll go ahead and get started. My name's Chris Field. I'm the Chief Growth Officer here at Holistiplan. Very, very excited to have you all today. We are nerds about tax and tax planning, and so something like this is very, very fun. Now, we are not the lead nerds, as we'll introduce you to Jeff in just a minute, but we are definitely nerds about this stuff. We love it. And to see how much interest a webinar like this generates for us is actually really fun, because knowing that there's a couple thousand people on this webinar represents tens of thousands or hundreds of thousands of families who have an advisor that cares about the tax implications of new laws. And that's good for people. And so that's why we're really ultimately excited to have you on here today and to be able to talk with you about the new Secure Act and what it really means for the families that you serve. So a couple quick things before I introduce Jeff. Again, my name's Chris Field. I'm the Chief Growth Officer here at Holistiplan. Very, very happy to have 2,000 of you on with us today. Very happy to have Jeff Levine on with us today. Very happy to have Roger Pine, our CEO, on with us. Once I introduce Jeff, we are going to go straight into his program because there's a lot of stuff in the new law, and he's going to go over all of that with you. And then at the end of his time, we're actually going to bring in Roger Pine, our CEO, and Roger is going to actually show you in Holistiplan the way we've already made these changes of this new law. So we are on top of it. You can feel rest assured we've got this stuff already programmed in for you and your clients. And then we're going to open it up to Q&A. So we do have the Q&A turned on. And what that's going to allow you to do is upvote. And if there's a question somebody asks that you would like to see answered at the end by Roger or Jeff, you could go ahead and upvote that in the Q&A. And if Jeff answers it as he goes, we'll take it out. And otherwise, we're just going to go with the questions at the end that have the very most people that are interested in knowing the answer. That feels fair when you have over 2,000 people on, that majority would rule when it comes to that case. So if you're one of our current subscribers, thank you so much. We love having you as part of the Holistipam, and we love coming to work every single day and serving you. If you're not a subscriber yet, we're really excited to be able to meet you today and for you to be able to see just a little bit of what we feel really, really passionate about. We started this company 3 years ago. Roger Pine and Kevin Lozer co-founded it, both CFPs, both love doing tax planning, saw massive value in it, and felt a little frustrated at times that it wasn't scalable. And so they built Holistiplan. And we're really honored and proud that in the 3 years that we've been a company, we've been voted the #1 tax planning software 3 times. And we're just about to hit 15,000 advisors that are using the software. And we're just really, really proud to know that there's that many people out there that are doing this sort of forward-looking for their clients. Jeff just came out with a really great article on kitsis.com talking about the difference between tax planning and tax advice. I highly recommend you go find that article if that's something you've been leery about. And finally, just know if you've never done much tax planning, you're not alone. as more and more advisors are coming into this space, we're absolutely finding that there are people who've not done much of this, but they really understand that KITSIS idea of value expansion, and they're adding this to their repertoire. And this becomes more and more important because our clients are expecting someone to do this for them and to look ahead. And it creates a really great opportunity for value expansion. So again, thanks for being here. We'd love for you to try out the software on a free 7-day trial once the webinar is over. All right, without further ado, Jeff Levine, CPA, PFS, CFP, AIF, CWS, and MSA. I like to just say all those. I know it's obnoxious, but I'm amazed that it's getting alphabet length, all those letters after his name. Jeff is the lead financial planning nerd for kitsis.com and the chief planning officer at Buckingham Wealth Partners. Something really cool that happened just a couple months ago. Jeff was actually named by Think Advice. He was given a Luminary Award for his thought leadership and his education. So he eats, breathes, and sleeps this stuff. He actually reads every page when this stuff comes out. Literally, he reads up, he stays up. We might binge Netflix. No, not Jeff. Jeff is actually binging new tax code and then creating tweet storms. You can actually follow him at CPA Planner, where he has a number of people, tens of thousands of people following him to hear exactly the kind of stuff that you're going to hear today. So Jeff, thank you so much for being here and helping us unpack the Secure Act. Don't forget to unmute, Jeff.
You know, this is the first time I've done this. I've never, first time listener, long time caller, you know, or first time, long time listener, first time, you know what I'm saying. All right. Anyway, it's good to be with you all. Thanks so much for that amazing introduction, Chris. And thank you all for taking the time out of your days, especially here as we start the year. This is always a really busy time. You know, we go from the busy year-end season to the busy start of the year season. There's really not a break for financial advisors during this time. What I'm going to go ahead now do is share my screen, share my slide deck with you all. I did see a couple of questions come in already asking whether these slides will be made available for you. Yes, indeed, we will make these slides available for you. Just note that if you see me looking off to the side here every now and then, I'm just checking the questions to see what's come in and whether I can answer any of them as we move through. Now, as we start here and we begin to go through these changes, we're going to talk about, boy, more provisions than you can shake a stick at. And I think I'd like to start there with just a comparison. You know, by now, many of you are at least familiar with the original Secure Act, the OG version, as I like to call it. And Secure Act 1 had about a dozen provisions in it. I actually went back and looked after this was passed. I'm like, am I really remembering it that, you know, was it that different? The answer is yes. Yeah, it is. Secure Act 1, the original version, had about a dozen provisions in it, whereas this has about 100 provisions in there. There's almost 8 times the amount of changes made by this latest bill as compared to the original Secure Act. Now, admittedly, no provision of this bill, no provision of Secure Act 2.0, the second version that was just passed enacted on December 29th last year, none of those provisions rise to the level of significance, impact, if you will, of the death of the stretch, right? That was a monumental change that impacted nearly every one of our clients with retirement accounts who's going to die with some balance in there. Because if you're married, you're probably leaving it to your spouse, and then afterwards, you're leaving it to someone other than your spouse. And if you're not married, you're probably leaving it to someone, well, you have to be leaving it to someone other than your spouse to begin with. So it impacted just about everyone. And it was a major change to the way we go about planning for clients. Nothing in this bill, you know, if that was a 7 or an 8 on the planning Richter scale, so to speak, there's no 7 or 8 in Secure Act 2.0 across the same number of clients. It has the same impact and immediacy of action for so many of our clients. However, the challenge with Secure Act 2 is the volume of changes. There may not be a 7 or 8, but there are a whole lot of 3s, 4s, 5s, and maybe even a 6 or 2. You get my point, right? Like by volume, there's just more to learn here. So here is going to be my suggestion as we move through for the next hour. It's this. focus on the 3 or 4 things intently that are likely to have the biggest impact for the greatest number of your clients. Pay, deep attention there. Everything else, not to ignore me, but I'm also realistic about what we can absorb as humans in an hour. And it's tough to take in 100 changes in an hour. So everything else, just try to take it in and have it sit in your mind so that when something related to that comes up, there's like a red flag in your mind. Say, oh, you know what? I think something changed there. You can always go back and listen to this again or review the slide deck, read the article that I put out. That's, nearly 12,000 words covering these changes as well. So there's plenty of places to go back and dive into the detail where you need. Your goal for today should just be to make sure that oh, something was there. So that if, for instance, you meet a new potential client who is a former first responder and they're receiving a pension, that there's some special tax thing for you in Secure Act 2.0. Let me do some research and get back to you for our next meeting. That's fine. That's your goal for today, being able to raise the red flag. Let's start with the change that is likely to impact the greatest number of your clients, and that's the pushing back of the RMD age. Now, notably, the law says that we're going to change the RMD age for those who are born who are 73 or older this year through 2032 to age 73. And then again, we're going to switch it in 2033, so 10 years from now, to age 75. That is overly complicated. So I've gone ahead and simplified it for you to the best way I know how, using a client's year of birth. If a client was born before 1951, Secure Act 2.0 does absolutely nothing. It does absolutely nothing to change their RMD age. It is going to be exactly the same as it was before. Now, if they were born from 1951 to 1959, then it's going to be pushed back from age 72, where it was before the Secure Act 2.0, to 73. They'll get 1 more year of tax deferral. For those who were born in 1960 or later, then they are going to see their RMDs pushed back to age 75. I will note that there is an error in the bill itself, a drafting error. Congress made a mistake. If you read the actual text of the bill, people born in 1959, that's why there's a little asterisk here, people born in 1959 actually are supposed to start RMDs at 73 and at 75. They made a mistake drafting it. I have confirmed that since with a number of people who are quote unquote like in the room while they were drafting this. So it is definitively an error. And as I understand it from those folks, the intent of Congress is that 1959 birthdays will still have an age 73 RMD starting age, and they will create some sort of technical correction here in the near future to address that. But as it stands now, there is some ambiguity to 1959, but this is the expected change. Now, obviously, there are some planning implications here beginning right away. For instance, no one starts RMDs as an owner because of their age. Right? Nobody this year as an owner reaches RMD age because either you were 72 last year and you started RMDs already, or if you're 72 this year, you don't start RMDs until you're 73. And if you're 72 this year, you're not 73 until next year. So there's nobody starting to take RMDs in 2023 because of their age if they are an IRA or 401k owner. But that change to the age, it did not change the age at which QCDs can be made. That was a very common question after the original Secure Act pushed back RMD age from 70 and a half to 72. It's come up again recently with the passing of this law from 72 to 73/75. There is still no change to the QCD age. That is age 70 and a half. Now, obviously, if you're making a QCD at age 72, but RMDs don't start until 73 or 75, you're not offsetting any RMD because you don't have one. But it's still a tax efficient way of making
gifts to charity for individuals with IRAs who are 70 and a half or older. For those who are not aware, when I say QCD, I mean qualified charitable distribution. That is the one-time ability to take money from not one time, excuse me, one time, when I say one time, up to $100,000 historically, I should say, per year, and have that money moved from an IRA to a charity. So you're able to do that each and every year up to $100,000. And we'll talk a little bit more about QCDs later on. Now, the good news is that this gives you and your clients a lot more flexibility, given that just a few years ago, RMD age was 70 and a half, and now for some, it will be pushed back to age 75. That's 5 more years of tax deferral for some people than they were expecting not too long ago. That's the good news. The downside is, and this is one of the areas where as advisors, we should focus on the most, this creates the potential to create what I started to refer to as the big tax crunch. And what the big tax crunch is a scenario and a problem for people who do not engage with proactive tax planning like you can and hopefully will deliver for them. Because if you're not engaging in proactive planning, if your mindset is simply, yeah, I don't have to take RMDs until I'm 75 now or 73 or whatever that is, well, that's all well and good, but it means you're going to squish the income from your retirement account into fewer years. You're going to live fewer years taking distributions if you start at 75 versus 70. But we also have to compound that with the fact that most non-spouse beneficiaries can only take 10 years at a maximum to distribute those dollars. So in the past, not too long ago, just 5 years ago or so, individuals had to start taking distributions at age 70 or 71, depending upon the year they turned 70 and a half, and their beneficiaries could spread the distributions that they had to take over their life expectancies, which may have been many decades. Now, owners don't have to start taking it until later on, and beneficiaries generally have to condense those distributions into 10 years, which means for a lot of people, a lot more income is going to be squeezed out into a lot fewer years, spiking tax rates, phasing out deductions and credits, all the things that if you look at, putting that income out in a Holistoplan scenario analysis, for instance, you're going to see right away, you're going to see those phase outs, open up range calc and see those giant spikes because you're pushing into higher brackets or phasing out of credits, phasing out of deductions. That big tax crunch, fewer years of forced distributions, plus fewer years of potential distributions for beneficiaries is going to create tax problems for a lot of people who don't work with proactive planners like yourself. Now, a note here that as we push back the RMD age, while the QCD age is not changed, the reason it's not changed is because it's hard-coded in the tax code, meaning it actually says in the tax code the word 70 and a half for when QCD should start. But other things like the special rules for surviving spouses who are inherited IRA beneficiaries, the rule for non-designated beneficiaries who inherit before the individual's required beginning date, all of those things are not hard-coded to age 70 and a half. Instead, they refer back to the provision that says at this age, RMDs start. So if your RMDs start at a different age for different clients, these special rules all change to that age. For instance, again, a surviving spouse who remains an inherited IRA beneficiary, they will not have to start taking RMDs until the decedent would have needed to start taking RMDs. That means they can wait until age 73 or 75 in certain situations. So those things change along with the RMD age change. Now, there are a number of Roth-related changes we're going to talk about here. One of them is that beginning in 2024, so next year, and one of the things I would urge you to do is pay close attention to the effective dates here because they're all over the place. We have some this year, some actually retroactive back to 2020 that we'll talk about, some that happen in 2025, others in 2026, all the way out into 2033, like we just talked about with required minimum distributions. So that can be a bit of a challenge when we're trying to plan for clients. So pay close attention to the effective dates. This one, beginning next year, says no more required minimum distributions for designated Roth accounts. That's plan Roth accounts, things like a Roth 401k, a Roth 403b, a Roth 457 plan. When you read designated Roth accounts, that's what it means, plan Roth accounts. Historically, even though Roth IRAs have not been subject to RMDs during an individual's lifetime, plan Roths, Roth 401ks, for instance, have been. Well, they won't beginning next year. And one reason that is extremely important for advisors to understand is up until now, and even maybe through the end of this year, moving money from a plan Roth to a Roth IRA made a ton of sense for almost everyone who was approaching RMD age, because why take money forcibly from an account that's growing tax-free when you don't have to, right? Let the money grow tax-free for as long as you can. Well, that meant that unless there was a really, really, really significant reason to leave the money in the Roth 401k versus moving it to the Roth IRA, you were going to make that Roth rollover. It was almost a no-brainer for most people. Now, however, that decision looks a lot more like the traditional 401k to traditional IRA rollover decision. And we're all familiar with our heightened regulatory requirements, the imposition of new rollover regulations and oversight, et cetera. We need to justify those decisions much more than we did in previous years from a regulatory perspective. So it's really important to be able to look at these decisions and indicate why we're doing it. Now, again, for the most part, this just aligns the Roth plan to Roth IRA rollover decision to the traditional 401k to traditional IRA decision more. In other words, analyzing investment options, looking at whether there's different distribution restrictions, looking at things like fees, et cetera. But there are still some Roth IRA advantages specifically to those accounts relative to plan Roth accounts. I thought I'd just give you a few of them here in case they are valuable for you or your clients, because they are reasons you could potentially use to help justify a plan Roth to Roth IRA rollover where it makes sense for clients. So one of them is, if you don't have a qualified distribution, plan Roth distributions are pro rata. So if I had $10,000 of deferrals to the Roth, and the account was worth $30,000. Well, 1/3 of everything in there is a contribution, but the 2/3 are earnings. If I took a distribution of, say, $10,000 from the Roth 401k and it wasn't qualified, I'm going to get 1/3 contributions, 2/3 earnings. But if that same distribution came from a Roth IRA, Roth IRAs have what are known as ordering rules, where the first money out, the first contributions are out first, meaning I could take the same $10,000 distribution from my Roth IRA and it would all be contributions. And because it's contributions, that would be tax and penalty free at any age and for any reason. So that's a benefit of the Roth IRA. There's also one Roth IRA clock for all Roth IRAs to determine qualified distribution status. So I often refer to this as like the Lord of the Rings Roth 5-year rule, because there's one Roth IRA clock to rule them all when it comes to qualified distributions for Roth IRAs. By contrast, if your client has had, let's say 2 or 3 jobs and they have different Roth 401ks, each of those Roth 401ks is going to have its own 5-year clock to determine qualified distributions. And also just note that eventually, usually even with a planned 401k, after death of the owner, that money typically makes its way to a Roth IRA. If there's never been a Roth IRA before, even if the distribution from the plan is qualified, even if you had 5 years and 59.5, let's say, in your plan, when the money goes to the Roth, if that's the first Roth money ever, then the new 5-year clock starts for the Roth IRA. So there are some still advantages to the Roth IRA you want to be aware of. Some other things to note, beginning this year, your clients can have Roth Simple and Rothsap accounts. Now that is the tax rule, right? That is the law, the legislation. However, I don't know of any custodian today that you could go to and set up a Roth Simple or Rothsap account. They have to update their paperwork, they have to update their processes, and also the IRS is required to determine what an election would be like to make the Roth Simple or Rothsap. And while it will probably look a lot like making a 401k Roth election, we don't have that information from the IRS yet, and it's part of what Secure Act 2 requires. So it's here by law. It will probably be here in practice relatively soon, but don't expect to be able to turn around and go to your custodian today and say, hey, I heard about these new things on that webinar I was on for Holistiplan. Can you show me the account paperwork? They probably don't have it yet. All right. As we look to other Roth provisions, there's another one here where additional employer contributions are eligible for the Roth. This includes matching, it includes profit sharing, so-called non-elective contributions, but only if they are not subject to a vesting schedule. Okay, only if it's not subject to a vesting schedule. You can see here, employer contributions must be non-forfeitable. The way I read that, and a lot of this is still going to be determined by IRS regulations over time, but the way I read that is someone would only be able to use this Roth election if there was a vesting schedule after they had worked long enough to reach fully vested status. Okay, that's how I believe that that will work ultimately. And finally here, this one is pretty significant for a lot of you, for your clients beginning next year. You know, as advisors, we tend to work with clients with higher income, higher net worth on average than the typical American taxpayer. Well, going forward, beginning next year, individuals will be required to make their catch-up contributions. That's those catch-up contributions for individuals 50 or older. They'll be required to make those contributions in a Roth plan. So a Roth 401k, a Roth 403b, a Roth 457 governmental plan, if they had wages from that employer in the prior year of more than $145,000. Now, note that this says wages. Okay, so it's very specific here about that. My reading of this, at least for now, the way I see this is individuals who are self-employed or who are treated as self-employed because they don't have wages, they will not be subject to this requirement. So someone with $146,000 of wages in 2023 would not be able to make a pre-tax catch-up contribution next year to the same employer. But someone who made $146 million if they were self-employed, they would presumably still be able to make those pre-tax contributions. Also, it's worth noting that this provision says the plan, right, of the employer, not a plan, not wages. It talks about for the employer. And so presumably if your client, let's say, worked this year from, I don't know, let's call it January to August, and they made $150,000, so more than 145. But in August, they changed jobs and went to another employer. And for the rest of this year, from that new employer, they only earned, quote unquote, $60,000 from August through December. Well, because they only earned 60 from that employer this year, presumably next year, they would still be able to make the pre-tax. In other words, it looks at your income, your wages, that is, from the employer. Now, a common question has been, well, what if my client is 50 or older and they can't make a Roth catch-up because the plan doesn't have a Roth option? You know, not all plans have a Roth option. I always say the Roth option for a plan is like the leather seats on a car. You can go in and buy the car and get the regular seats, or you can go in and buy the car with the fancy leather seats, but you can't go buy the leather seats without the car, right? That would just be weird. So it's the same thing with the Roth side of the plan. You can get the Roth option with the pre-tax, but you can't just get the Roth option alone. If the plan doesn't have a Roth option, and there's an individual who would have to make their contributions to a Roth account because they are over 50, and so they're eligible for catch-up, but their wages were over 145,000. The catch-up rules in totality do not apply to that plan anymore. In other words, no one gets to make a catch-up contribution whether they had more or less than 145,000. If one person has to, but they can't, nobody gets to do it. So that is a significant thing. And I know we've got a lot of provisions to cover, but I did want to make one note here about Roth accounts before we move on, because I do think it's an important practical point for advisors. You know, we're often asked by clients, can I trust the government about, and then finish the blank, right? And typically, if the client starts off a question saying something like, can I trust the government to keep its word? Like, usually the answer is going to be no, right? Just because we don't know. Different regimes change all the time. One party has control. They want to do things one way. A couple of years later, the other party has power. They want to do things their way. Very difficult to predict future legislation and what's going to be the case, 10, 15 years from now. However, when it comes to Roth IRAs, if the question is, can I trust the government to keep its word about the Roth? I believe the answer to be yes. And the reason I do that is not because I have this insane level of trust that our politicians will never change things. It's because it's in their best interest to keep the Roth around. And to that point, you can see here in this bill, the Roth provisions we just covered aren't trying to limit access to the Roth. The first three we talked about, the first three provisions we just talked about, either make it better by eliminating RMDs for the plan account, or give people more options. The creation of SEP Roth, the creation of simple Roths, more option to get employer money directly into the Roth account. It's more. And the last provision we talked about was a forced Rothification. You must put your money in a Roth IRA, or excuse me, a plan Roth at that point, if we're talking about high income earners. So that is a huge deal. Congress is not trying to get rid of these things. If anything, they want to use them more, because let's look at it from Congress's point of view. They bring in revenue now, and people like them. Think about it. What else can you say that about? Name me one other provision where clients like it, but it raises revenue today. You can't do it. And because of that, you should expect, in my opinion, the Roth to stick around for quite some time. Now, to that end, there's one other Roth provision that's worth noting here, and this is one that has been something that's been asked a ton lately, which is, help me understand these 529 to Roth IRA transfers. So effective next year, money will be able to go from a 529 plan to a Roth IRA under certain conditions. First off, it must be moved directly from that 529 plan to the Roth. So no 60-day rollovers from the 529 plan to the Roth. It must go direct from the plan to the Roth IRA. And it has to go to the Roth IRA of the beneficiary of the 529. Now, you can change 529 plan beneficiaries. So theoretically, you could adjust who the money goes to in the Roth IRA by moving the money in the 529 plan first to a different beneficiary, but it does have to go from like to like beneficiaries. And it's worth noting that while that sounds really great, right? Sounds pretty good. There are a lot of restrictions here that really limit an individual's ability to use this to any great degree. I'm not saying it has no value, but I'm saying it's not nearly as great as some people are making it out to be. First off, the beneficiary has to have compensation. I do believe ultimately that Congress will eliminate that requirement. I don't think they really wanted that, but the way they wrote the law, it does appear that a beneficiary has to have compensation, so generally earned income, in order for that to be the case. So that's the first thing. The second is the most you can move in any 1 year is limited to the IRA contribution limit. So that's it. Let's say the IRA contribution limit for your client is $6,500. That's all they can put in any 1 year from the 529 plan to the Roth. And if they do that, they can't make any other regular Roth. In other words, it's not $6,500 here plus $6,500 there. It's just however you want to get the money in, regular contributions or 529 plan to Roth, a total of 65, or the annual IRA contribution limit for your client could go there. Third, if you do that, even if you did that multiple years, the most you could do over the course of a beneficiary's lifetime by that is $35,000. And then as we continue on, there's a 15-year waiting period from the time the account is first opened before you can do this. And none of the money that went in during the last 5 years is eligible, even if you're over 15 years. So in other words, let's say your client had a 529 plan that they opened up 20 years ago for their kid, right? And their kid is just finishing college now. And they hear about this. They say, oh, you know what I'm going to do? I'm going to leave my account open so I have my 15 years satisfied. That's good. And they certainly could put a new contribution in there now with the idea of moving it over to their kids' Roth later on. But they'd still have to wait 5 years for that new money to go over there. So it's 15 years before any money can go over. But once those 15 years have been met, any money, any contributions and the earnings on those dollars that went in during the past 5 years would still be ineligible. All right, there is a new option here for surviving spouse beneficiaries. Historically, surviving spouses have had a very unique set of options that no other beneficiary has. They've been able to take the decedent's IRA and move it into their own, right, as a spousal rollover. No one else can do that. They have been able to set up an inherited IRA, but have special rules about that inherited IRA for when they have to start taking RMDs. And once they did, how much those RMDs would be relative to other beneficiaries. So surviving spouses have had a number of spouse-only options. Beginning next year in 2024, we're going to add one more. The Secure Act 2.0 says a surviving spouse will be able to elect to be treated as the decedent. So whereas today, a surviving spouse can take the decedent's IRA and put it into their own, and the treatment of that is that we treat the money when it goes into the surviving spouses as it had always been the surviving spouses. This will allow us to pretend that the surviving spouse is the deceased spouse. So generally, this is going to be advisable when that surviving spouse is older, right? If the surviving spouse is older and the deceased spouse was younger, I can opt to use the deceased spouse's age for RMD purposes because they're younger and I can take less out of my account. That's where this is going to be valuable. Now, a few notes about this. First off, the way the law is written, it talks about 401A9 and the regulations thereunder. Now, I don't expect you to know what that is off the top of your head for the tax code. Just take my word for it. 401A9 is where we talk about required minimum distribution rules. It is not where we talk about the 10% penalty or taxation. That's under section 72, right? 72T, all that sort of stuff. That's where we get that. So I think even though this might help to, like, if we elected to be treated as the deceased spouse, I think that helps us for RMD purposes, but I don't think it would help us if the surviving spouse was younger than 59 and a half and the decedent was older than 59 and a half. I don't think that helps us get out of the penalty. So keep that in mind. I think this just works for required minimum distributions. I would also note here that this election, it says that it is irrevocable unless the secretary, meaning the IRS, allow an individual to change it for, it's approved by the IRS. So until we know what it will take to revoke such an election, we should treat it as being an irrevocable election. And the ultimate impact of all of this is that, again, a surviving spouse, if they're older, would be able to elect to be treated as the deceased spouse for RMD purposes. That would allow them to delay RMDs until an older age. It would allow them to have smaller RMDs once they get there, et cetera. And I know this isn't pretty. I know it's not pretty. And maybe some of you are looking at it on a small monitor, or probably even worse there, or on your phone, heaven forbid. But you all have access to these slides. This is my first stab, if you will, of thinking through all the different permutations and combinations of things that happen when a surviving spouse, or when a spouse passes away and leaves money to a survivor. All the different thought processes we have to go through. Do we care about how their ages are relative to one another? And What are the ages compared to age 59 and a half? And what's the most important thing for the survivor? Is it limiting RMDs? Or is it having penalty-free access to money? All of those drive the decision as whether we should leave the account in the name of the decedent and elect to be treated as them, whether we should do a spousal rollover now, whether we should do a spousal rollover later, or whether we should set up a properly titled inherited IRA. There's so many different options. And so, if a client ever says, like, what do you do for me and why am I paying you? Like, put this in front of them and show them you pay me because I have to know this on your behalf. When things go wrong, it's complicated like this. So again, love to hear your feedback once you have time to actually soak this in and look at it. I don't expect you to do so now, but this is my first attempt at helping everyone kind of carve through the thought process that they should be going to when one spouse dies and leaves money to a survivor. All right, note here that we've got some new catch-up contribution limits beginning next year. The IRA catch-up contribution limit will be indexed for inflation. It was first introduced back, I believe, by EGTRA in the early 2000s at $500. In 2006, the $500 amount was indexed, or was increased, I should say, to $1,000, but it wasn't indexed for inflation. Of all the retirement account contribution limits we have, the SEP contribution limit, the simple IRA deferral, the 401k deferral, the 401k, everything is indexed for inflation to this point, except for the IRA catch-up. That is rectified as part of Secure Act 2.0. Beginning next year, it'll be indexed in $1,000 increments. Also, beginning in 2025, so 2 years from now, there will be special catch-up contribution limits just for individuals who are 60, 61, 62, or 63. If you're 64 and you want to put extra money into your retirement account, no soup for you, right? As the Seinfeld episode goes, right? You can't do it. Only at 60, 61, 62, and 63. Those 4 years only. And, like we used to have the Medicare donut hole, right? Where coverage would be good, then it would go bad, and then it would be good again. Well, this is like the reverse donut hole. I guess some people have been telling me, like, it's just the donut, Jeff, or other people saying, well, if it's the reverse donut hole, maybe it's just like the munchkin or whatever. I guess it depends upon whether the hole is the actual space or the circle thing that you can pop out and eat like a munchkin. Anyway, I digress. Point here being is that it's okay. We have catch-up contributions from 50 to 59 that are like normal catch-ups. Then you get this reverse donut hole type of thing where it's great. You get even more money into the 401k from 60 to 63. But then at 64, it goes back down again to the regular catch-up contribution. Now, I will admit the language is a little bit odd in how they go about talking about what that limit will be. It appears that it's going to be 150% of the regular catch-up contribution amount, which this year, if it was in place this year, it's not, but if it was in place this year, that would mean $11,250. So it's likely that once we get to 2025, it'll be somewhere close to, 12,000, 12,500, somewhere along there, depending upon what inflation is over the next years. Simple IRA catch-up contributions, same thing for individuals who are 60, 61, 62, or 63. They will have special simple IRA catch-up contributions limited to the greater of $5,000 or 150% of the limit in that year. Again, the limit this year is already going to make it more than 5,000, so that appears to be where we land there. There are a couple of changes to qualified charitable distributions. We noted these earlier. This is that annual ability to take up to $100,000 from your IRA and to move it to charity each year for those who are 7.5 or above. There are two changes that you should be aware of from the Secure Act 2.0. The first is beginning right away, right now, effective this year, individuals, taxpayers, your clients have a once in a lifetime, one-time ability to take up to $50,000 and move that money to a split interest entity. In other words, something like a charitable remainder trust, a charitable annuity trust, or a charitable gift annuity, the things where charity gets some money, but so do I as the person. Those are split interest entities. The rules say you can do up to $50,000. Now, that might sound good, but I would suggest to you that there is probably a very limited case for this being the right decision for a client. And that's not because I'm anti-CRUT or anti-CRAT or anything like that. It's because the rules say that if you move money in this fashion, up to $50,000, to a CRUT or a CRAT, then you can only fund that CRUT/CRAT, whichever you're talking about, with QCD money. In other words, that $50,000, that type of money can be the only money that goes into the charitable remainder trust. And the rules further state that the only income beneficiaries, in other words, the only people who can get money out of that charitable remainder trust or charitable annuity trust, are the owner who made the QCD or their spouse. So if we combine that and we say, okay, the husband and the wife, in this example, the married couple, each put $50,000 of QCD money in, that's $100,000. That's the maximum. But think about the cost it takes to set up a charitable remainder trust and then to maintain it with annual tax returns and compliance and all that sort. It's hard to imagine $100,000 being worth it there. And on the charitable gift annuity side, there are additional restrictions there. You can see as well that has to begin paying out within 1 year, like all sorts of challenges associated with that as well. So it exists, you should know it. But I present these rules to you more to say, if clients ask about this and say, hey, I heard about this new thing, your response to them is probably like, yeah, Mr. or Mrs. Smith, but it's not as good as it sounds. Let me tell you why. And it's probably, every client is different, but it's probably not going to be the right thing for them. The one other thing I'd note here is beginning next year in 2024, the 100,000 maximum QCD amount will be indexed for inflation. All right. Now, as we look through here, we're, I don't know, maybe a third of the way through of the slides, and we're 45 minutes. We're 3/4 of the way through our first hour together or so. So what I want to do now is I'm going to, and I'm setting this up so that you don't say, well, Jeff, you went through it so quickly. The next group of slides all represent new access to money for individuals who are either under 59 and a half or some other thing that helps people get access to money in times of need at young ages. We're going to go high level on these things and move through because 99% of you won't remember all the technical 3 years for this and take this distribution tomorrow anyway. There's a lot of information we're covering. What I want you to do is think high level categorically, like these are the types of people who are impacted. So for instance, the age 50 exception, which allows public safety workers to access money penalty-free as early as age 50 from their retirement plans, is expanded. More people are now considered public safety workers. So public safety workers will now include private sector firefighters. I know, a little bit weird. Private sector firefighters considered public safety workers, but they now qualify. State and local corrections officers qualify. Individuals who are working for their employer by more than 25 years, they also qualify for the age 50 exception. So if you're working with a public safety employee, this is where you say, oh, there might be something here for you, and that is effective immediately. Also, retroactive to last January, actually 2 Januaries ago, almost 2 years now, January 26th of 2021, there's a renewed ability to take disaster distributions up to a maximum of $22,000. These look a lot like the coronavirus-related distributions that we all dealt with at the start of COVID, where people could take up to $100,000 and spread it over 3 years and pay it back for up to 3 years. All those same rules apply here, except the maximum amount that you can take in a lifetime is limited to $22,000. There's a new terminal illness exception to the 10% penalty. And this actually, to the extent that one could say it's a favorable definition for such a horrible thing, right? We're talking about terminal illness. It applies here. It's a very liberal definition, broad definition. Normally, the tax code for things like, can I get certain insurance money out tax-free, says terminal illness is within 24 months, 2 years. This definition says you can access money penalty-free from your plan if you are terminally ill, with a definition of within 84 months or 7 years, right? 7 years. So if your client is 50 and the doctor says, you know what, I think it is likely you're going to pass away, unfortunately, by the time you're 55, they are now able, even if they're not disabled, right? Not everybody who is terminally ill is disabled at that moment. Sometimes people are diagnosed and we know it's not going to be a long time, but it will be quick when it happens, if you know what I mean, right? These are the terrible things that unfortunately some of us either have to deal with our own families or certainly with our clients from time to time. If death is reasonably likely within the next 84 months as certified by a physician, then penalty-free access to retirement dollars will be available there. For those who are victims of domestic abuse, so sad we are at a point in our society where we have to carve out an exception for this because it's so common and whatnot. But sadly, this is where we are. Those individuals beginning in 2024, so not yet this year, but next year, would be able to take up to a maximum of $10,000 or half of their vested balance out without a 10% penalty. There would be a new, or will be a new, emergency withdrawal exception next year. Look, here's the thing. It's really broad. That's great, right? This is finally the quote unquote hardship exception everybody wants. I just need money. I've got an emergency. Let me get my money. This is it. That's the great news. The downside is it's limited to a maximum of $1,000, right? Not very sufficient for most people's emergencies. So it'll be there. It will exist beginning next year, but it will be up to $1,000 at a maximum. Along with that, though, there's yet another 10% penalty exception introduced, qualified long-term care distributions. These say that beginning effectively in about 2026, it's technically 3 years after enactment. So the last few days of 2025 and beyond, clients would be able to take up to $2,500 or 10% of their vested balance out, whichever of those is less, and use it to pay for long-term care insurance premiums without a 10% penalty. And if somebody puts in too much money into an IRA or 401k and they have to take that money out, they usually have to take out the earnings associated with it as well if they're doing it to try and avoid a penalty. The earnings historically have been subject to a 10% penalty for younger clients. Now they will not be. All right, so those are all like new 10% penalty exceptions. There's also some changes to the rules. For instance, historically 72T distributions. Well, if you started them, you weren't able to split the account afterwards. In other words, let's say your client had $1 million and you calculated 72T distributions for them, and they started taking $40,000 out a year from their 72T accounts. Well, they weren't able to split that $1 million up. Maybe they didn't like that advisor or that investment anymore. They weren't able to say, take half my account and move it somewhere else because I don't want to have all my eggs in one basket or something like that. There was considered a modification and triggered a retroactive 10% penalty on all pre-59.5 distributions. Going forward, beginning next year, those partial distributions or transfers rather will be allowed, or rollovers, provided that after the split occurs, the same total dollars come out from those two new accounts as came out of the single account beforehand. So in other words, if I had my $1 million and I was taking 40,000 out and I split my million into two accounts, 700,000 and 300,000, from the $700,000 and $300,000 accounts, I need to get some combination of $40,000 out after I make that change, and that would be okay. Note that just like we have expanded qualified distributions for individuals in disaster areas, the loans that they're eligible to take are also increased. That is another permanent change here. And beginning next year, we're going to have a new type of savings account linked to employer plans. So to be very clear, these are not like standalone, hey, let me go set up an HSA or let me talk to my advisor and set up this account. These will be attached, if you will, to a 401k or a 403b. And these emergency savings accounts will effectively act like bank accounts, but with some neat little benefits associated with them. First off, employers will be able to auto-enroll individuals at up to 3% of their compensation into the savings accounts. And here's the big benefit of using these relative to just stashing money in a bank somewhere, or even putting money in a Roth IRA. The money that goes in there will be eligible for employer matches in the same manner as if it had gone into the 401k directly, right? So instead of putting money into the 401k, the client says, I need to establish my emergency savings first. They do that. Well, now the employer is still going to be able to match that contribution to the 401k. All right, let us continue on here, talk about some other important provisions you should be aware of, some relief for mistakes. One thing is clear here, and that is there's a lot of rules and it's easy to make a mistake. Well, beginning this year, the 50% penalty for making a mistake with an RMD is reduced to 25%. And if you timely fix it, what the law says, correcting it or fixing it during a quote unquote correction window. I won't get into the nuances of how to define that. You can read it here a little bit, some bullet points, or if you want to go deeper, you can read the law or my article. But suffice it to say, for most people, this should be a multi-year period where you can fix that mistake. And the 50% penalty, if you do that, will be reduced to just quote unquote 10%. And if you want, if you've got a good excuse of why you missed it, you'll have new ways of going about dealing with that as part of EPCRS. EPCRS is an acronym for Employee Plans Compliance Resolution System. This is a part of the IRS that deals with helping plans fix mistakes so they can remain tax qualified. Historically, it's been used just really for plans. The Secure Act 2.0 directs the IRS within the next 2 years to issue new guidelines to expand this for IRA relief as well, including the missed RMD penalty. It also sets the statute of limitations for certain IRA penalties at 3 years for the missed RMD penalty and 6 years for most excess contribution penalties. That is now going to replace what is for most people today an indefinite, or what used to be an indefinite period of time. Like there was no statute of limitations for most IRA penalties. Now going forward, it will be 3 years for a missed RMD and 6 years for most excess contribution penalties. There's a new ability to make retroactive deferrals for sole proprietors. Many of you are probably aware that if you have a client who, let's say, came to you today and said, boy, I made a lot of money last year, but I didn't have a retirement plan. You've long had the ability to, even though it's after 2022, you could tell the client, hey, let's set up a SEP IRA for you now. We can create it retroactively for that last year, and you can fund it for last year. The Secure Act, the original, the OG version, expanded that retroactive SEP ability to retroactive profit sharing plans, retroactive annuity purchase plans, retroactive pension plans. That's all been the case for a few years now. Secure Act 2.0, the new version, says, let's expand that further. Let's let a sole proprietor in that first year that they establish a plan. So like, let's say next year you're sitting down with somebody in March of 2024, and they say, I really probably should have had a 401k. Well, you'll be able to establish it in March of next year and not only have them make their profit sharing contribution, but let them retroactively put in salary deferral amounts as well. So that's a new benefit, and that is effective for plan years beginning after the date of enactment. So any plan that has a plan year starting after December 29th of last year. There's a new benefit here for disabled first responders. Again, just put this in your mind. If you work with any disabled first responders beginning in 2027, so we're still 4 years out, the money that they received prior to retirement age on a disability pension, which is tax-free, will be able to continue to be tax-free after they reach full retirement age. Historically, there's been a flip there where the pre-retirement age money paid to them on disability pension was tax-free, and then the retirement age pension that was paid to them afterwards was taxable. It will now continue to be tax-free in the same amount as it was before they reached their retirement age. I'll note a few annuity-related changes that you probably want to be aware of. Beginning this year, or actually effective immediately as of the Secure Act, so technically as of December 29th last year, the 25% limitation on qualified longevity annuity contracts is repealed, and the maximum purchase amount is increased to $200,000. It was set to be, I think, $155,000 this year, maybe with the inflation adjustment. It's now $200,000. There's a renewed ability or a new ability to have annuities add more bells and whistles to an annuity that is within an IRA without running afoul of the RMD rules. Without getting into the nitty-gritty of the actuarial regulations about why things work or don't work, there's been some challenges with offering certain benefits for annuities that people are accustomed to outside of retirement accounts, inside of retirement accounts. Many of those are now okay. So you can see here a list of those on the bottom. For instance, annual inflation adjustments of a flat amount, not actual cost of living, but every year will increase your income by 3%, 4%. Anything up to 5% is okay. A benefit to stop annuity payments and to get an actuarial payment, a lump sum amount, that's fine too. Dividend-like payments, these are all okay where they were not before. And beginning in 7 years, we will have insurance dedicated ETFs. Effectively today, if you look at a lot of VAs and variable universal life contracts, you see things like mutual funds and maybe even index mutual funds, but you don't see ETF style investments. You'll see them a lot more in all likelihood beginning in 2030. All right, as we move along here and we finish up our time together, let me just move on to a couple other high level things. ABLE accounts, the accounts for individuals who have experienced a disability prior to age 26. They are going to be expanded for individuals who have been disabled prior to 46 in 2026. A lot of sixes there to keep track of. But again, just in a few years, in 3 years, clients who have been disabled prior to age 46 will be able to have ABLE accounts. So this is great news, relatively, again speaking, for those who are disabled from 26 to 45. Historically, they haven't been able to set up one of these ABLE accounts. Now they will be eligible to do so. A note here that Congress is really leaning into the simple IRA misnomer. Many of you probably agree with me that simple IRAs are anything but simple. Well, going forward, they're going to be even more complicated. I won't get into the nitty-gritty here because, frankly, you will all hate me for doing so. But there will be new abilities for employers to make additional contributions, almost like profit sharing to the simple IRA beginning next year. And employers who have smaller, like true small employers, like those with under 25 employees, will actually see the limits for how much somebody can defer into the plan increased by 10%. So now going forward next year, if your client comes to you and says, hey, I'm 52 years old and I have a simple IRA through my employer, you won't actually be able to tell them how much they can put and defer into that plan unless you also know how many employees their employer has. I mean, can you imagine how ridiculously complicated that makes things? And then there's all the other stuff associated with a plan. So we've got an ability for employers to match student loan payments. There are lots of changes to 403Bs. The savers contribution or the savers credit that we have is going to be replaced with a savers match, effectively a tax credit that has to be put directly by the IRS into your traditional 401k or traditional IRA beginning in 2027. Additional changes to startup credits. People who have military spouses, there's going to be new benefits for employers to adopt special provisions in their plan to encourage employers to get military spouses who move around a lot more benefits quicker. Auto enrollment. I saw a question come in early today. Are they going to have auto enrollment? Yes, there's going to be mandatory auto enrollment beginning in 2025, except so many plans won't have to actually have the quote unquote mandatory auto enrollment. Because if you're a plan in existence before this, or a church plan, or a governmental plan, or a plan which is sponsored by an employer with 10 or fewer employees, or any size business that's not 3 years old, none of those are going to be eligible or be required to have mandatory auto enrollment. So it's very watered down. And then finally, I mean, I call this the make it stop already changes, because I'm sure your brain, like mine at this point, is fried and you're just saying, Jeff, make it stop, please, no more. New 401k plan next year called a starter 401k. Maximum amount that could go in there, limited to the IRA contribution limit. Household employees, like your clients have a cleaning person or a nanny that they employ. You can have them set up their own SEP IRA for those people now. All sorts of things. I'm going to just skip ahead to this last part here. You know, I say it, I got 99 retirement changes here, but this switch ain't one. Of course, this is my Jay-Z reference portion of the show. And here, what we're talking about, well, everybody wants to know what isn't in the bill. Note that there are no changes to the backdoor Roth rules, no changes to the Roth conversion rules, no changes to the age at which QCDs can be made, no new RMD rules that require required minimum distributions because your balance is too big, or restrictions on what investments can be held in an IRA. And sadly, I'll hit on this last bullet point. No clarification of the 10-year rule for non-eligible designated beneficiaries. Most non-spouse beneficiaries after the Secure Act fit into that group. So I will pause there and simply say, I know Roger wants to share with you a little bit about how Holistiplan has integrated some of these many changes into the software already. It's one of my favorite things about Roger and the team is how quickly, anytime new legislation comes out, they include it. But before I turn it over to him, and then we'll take some questions, I do want to say, if you haven't already had a chance to do so, please, reach out, connect with me. I love to keep in touch with folks, and I try to answer as many questions as possible. You can reach me on Twitter at CPA Planner or at LinkedIn at the address you see there. Roger, I got to come up for air and take a breath here. So over to you, my good friend.
Yeah, good. Thanks, Jeff. Jeff, maybe you could peruse the Q&A a little bit while I'm yapping here.
That
and
works.
Feel free to jump in if you want. Yeah, like Jeff said, I mean, Jeff has been a friend to us for a number of years as a tax planning strategist here at Holistiplan. He's been a member of our team. And what I enjoy about these tax changes is, like, there'll be nights where Jeff is busily writing his 20,000 word essays. Meanwhile, I'm up at the same time with our development team making code changes. And so, I don't know, it's kind of fun, kind of like the back of the college years of eating pizza in the middle of the night, getting that term paper done. I'm going to share my screen real quick and just show a few things that we've changed, edits we've had to make to the software in response to Secure Act 2.0. If you're on this webinar and you are someone who has never used Holistiplan before, the bad news for you is, like, I'm not really going to be demoing Holistiplan. Like, a lot of the cool things that Holistiplan does, I'm not going to be showing you today. That do a trial. There's people who would be happy to show you what's going on with the Holistiplan. A lot of the things that I had to change were actually around the periphery of the main things that Holistiplan does, which is reading in a tax return, helping you do some planning, some forward-looking scenario analysis, stuff around the edges. So, Jeff, maybe you can help me. You see my screen on it? It says
I do.
It's like the main Holistiplan website. All right.
I do.
Let's log in here, go to my account. So one of the things that happened pretty early on is we realized that a lot of tax planning strategies, as Jeff just went through, are dependent on certain age milestones that you hit. RMD being a big one. And let me pull up this age reminders screen. So again, we're kind of on the periphery of some things you can do within Holistiplan, but a good example is RMDs. That's a critical thing related to tax planning, because in many cases you may be trying to bring income earlier through a Roth conversion or something like that prior to your RMD age. During your RMD times, you may be relying on something like QCDs to offset some of the tax implications of your RMDs. You may just be using RMDs as a way to handle estimated tax payments, right? I mean, instead of doing estimated tax payments, people who have large RMDs can do withholding through their RMDs. In fact, they can do that at the end of the year instead of having to spread it out throughout the whole year. So we realized pretty early on that there's a lot of age-related things that are programmed into our system. And so we actually built a whole screen that we call the age reminder screen. This is available to our premium subscribers. And I don't have a huge database here that behind my little demo here, but imagine if you have hundreds and hundreds of clients and you're trying to figure out, okay, which are the clients, and let's use as an example, who are the ones who would have turned 72 and would have entered RMD age this year, but are not. That's probably a conversation you should have with those clients. And so I could filter on those people who are 1 year away from RMDs, and that's these two people here. And within Holistic Plan, here's some stuff like I can click to see like what is some actual sample language I might use within that conversation if I want. We have links to third-party sources for information. But the point is, because of the Secure Act 2.0, there are certain conversations that are worth having like right now, actually, with a certain subset of your clients, especially those who were going to be entering RMD age. Again, hey, all that stuff we were talking about 3 months ago about how you don't have to worry about estimated taxes in 2023. Actually, you know what? There's another year. And remember how we were doing Roth conversions all the way up to RMD age? Well, actually, maybe we look at it in 2023 as well. It's a conversation that should be happening now, so that they don't read about it in some like AARP article 3 months from now. Like you can be the one to be the first one to have that conversation with them. Another thing we had to program in, let me say, let's pull up all the age reminders that are popping up next year. Let's see, whoops, I don't want just the people who are 1 year away from RMDs. Let's give all of them. One of the things we had to program in was in 2024, there are certain people who will be eligible for this new, they'll be 1 year away from this new extra mega, we need a cool name for it, Jeff. There's
All
the
right, I'm on
catch
it.
up,
I'm going to work on it.
extra mega catch up. You know, the 457 plans.
That sounds like something you'd order on a sandwich. I'd like some extra
yeah.
mega ketchup, please.
Well, you know, in my old firm, we dealt a lot with people in academia, and 457 plans do allow you in your last 3 years before you can double. And so we call that like a super catch up. So we got to be careful anyway, but the point is like, there's this mega catch up you can do from 60 to 63. Here's something where our age reminders can show up. We can filter on, okay, who are all the people who are going to be eligible for this starting next year? Let's get ahead of that and have that conversation with them. Just real quick, within age reminders, you can actually get a digest. So if you want an email digest of give me everybody who in the coming month is going to become eligible for Medicare, and we got to have the Part B conversation with them, that's a thing that Holistic Plan can send out to you. So that's the age reminder stuff. Again, this is not central Holistic Plan stuff. This is kind of cool stuff around the edges. So if you think this stuff is cool, there's other cool stuff too. Within the scenario analysis screen, now there's not, Jeff didn't really mention any tax calculation changes. There were a lot of rules that may change the way we model certain things. We may want to model certain strategies, but the actual way taxes are calculated themselves, not really big changes there. So again, these are things around the periphery that we had to change. Let's see here. Roths. So we have a Roth conversion one pager. This is kind of like a quicker version of what you may build in like your tax planning software, where you're creating some longer term projection as to what is the benefit of doing a Roth versus not. We have a tool within Holistic Plan, again, available to our premium subscribers, where we're able to show, okay, that Roth conversion that you modeled within scenario analysis, what's going to be the long-term impact of that based on certain spending assumptions and stuff like that. We had to, first of all, edit the RMD ages to incorporate the fact that it switches to 73 or 75 based on how old the person is. So that delays the RMDs a little bit. We also had to change based on what Jeff was talking about with respect to if the older spouse outlives the younger spouse. Make sure I get this right, Jeff.
Yep.
If the older spouse outlives the younger spouse, they have the option, and probably in many cases would, elect to take the lower RMD. And so we had to program that into the system as well, so it would automatically switch to that, which in both of those cases, Jeff, it actually makes the math of a Roth conversion a little less compelling, slightly less, because of the RMDs being either later or less, depending on the circumstances. But it's at the margins, but it would actually make the Roth conversion case slightly less compelling. In this case, still pretty compelling, but less so. So that's another thing we had to change. Let's see, I'm looking at my notes here. I didn't have it all memorized. Okay, going back to that scenario analysis screen, qualified charitable distributions. This is a small change, but if you model a qualified charitable distribution within Holistic Plan, it does allow you to bring up this QCD report. So if we're trying to explain to the client the benefit of doing a QCD, there's all kinds of like stuff showing that side by side, if you do a QCD versus take a taxable distribution and deduct it on Schedule A. The only thing I changed on this report was we just have this information about the fact that It will be indexed to inflation. We don't know exact numbers yet, but it will be indexed to inflation. So again, this is another change that we have to make related to the fact that QCDs are now going to be starting, not this year, next year, right? 2024 indexed to inflation.
Correct.
So 100,000 still in 2023, but 2024 indexed for inflation. And so that's actually one of a couple things I wanted to show that are not in the product right now, but probably will be in the next couple days. Let me go back to the scenario analysis screen. But I was in that qualified charitable distribution screen. If I try to put in a QCD amount of more than 100,000, it's going to yell at me and say, you can't do that. And so we just need to make sure that in 2024, we'll index that to inflation, which is not a problem. There's plenty of things within the software that are already indexed to inflation, like standard deductions, like brackets, all kinds of good stuff.
Well, I'd also note, Roger, you guys have a lot of guardrails within the software like that on other things to keep advisors or whoever's using the software from making potential mistakes, like to put in a number that can't possibly be right.
Yeah. Yeah, we have some of that. And the more of that we can add in, the better, because that's where it starts to get dangerous.
There are a lot of rules.
There's a lot of rules, Jeff. That's what keeps you doing webinars, is those rules.
That's it. Job security, hashtag job security.
There we go. I think the final thing, and I don't even know if I could really show it. Actually, let me show another thing we changed. So actually, this is something that people who have never seen a Holistic Plan might appreciate. When you upload a tax return, this is the tax report that's automatically generated. It takes about a minute, and it's got a lot of summary information about the tax return, and it's got at the bottom these system generated, we call them observations. And one of the things I had to create was, this is something I ran on a 2023 scenario, is this client was 1 year away from RMD age. So we had to just change the math on when someone reaches RMD age. I will say that the other piece that we need to program in, once we know a little bit more about the age 60 to 63 super mega catch-up, patent pending on that name, we need to make sure that we program in the income limitations that Jeff was talking about for that and the Roth behaviors and all that stuff. So, but that's the beauty of using software, is like all these things. Let me go up here. Like, here's a good example. Like, who is calculating the modified adjusted gross income for all these different things when they get a tax return in? Like, that's not a good use of a human's time. It's good use of a computer's time. A computer can do that really easily. And so that crazy PowerPoint that Jeff put up with all the stop signs and stuff, like, that's made for computers, not humans. And so that's the sort of thing where having tools that are built once instead of having to do it in your head every single time are really, really valuable. I think I'm just looking at my notes. That's all the big stuff that we had to change immediately following the Secure Act, which it was nice of them to sign that on Christmas Eve. So Jeff could be writing that week and I could be coding that week. It was very kind of them to do that. But yeah, that's what we put together last week. And so that's all in the system right now. I'll turn it over to you, Jeff. I will stop sharing.
All right. Well, we have a lot of questions here, so I'm going to do my best to get through as many of these as possible. So the first question talks about, hey, and I'm summarizing here, but if these new Roth contributions are going to be allowed into a Roth, is that going to be subject to FICA? Is that going to be subject to employment taxes? And the answer there would be no. So it won't be subject to employment taxes, but the amount will be included in someone's gross income for the year. So if you have a scenario where, let's say, someone puts a $5,000 match and they elected to go to their Roth, it will basically, the end result of the taxation will be, imagine a regular match, right? Not subject to FICA or anything like that, went in and then they converted it. That would add $5,000 to their ordinary income, but not change employment taxes. The same thing will be here as well. Question number 2, does the 529 plan balance to transfer to a Roth? Does the 35,000 lifetime limit apply per account or beneficiary? It appears, I'm going to say appears here because it's not entirely clear from the legislation. We're going to need some IRS regulations here, but it appears to be per beneficiary. And yes, it seems likely that you'd be able to change the beneficiary and do additional amounts. Jeff, can you please expound a bit on the 2024 rule about matching contributions to go into Roth 401k provisions for those over 143,000 in wages? So note it's 145, no big deal, but I got your, what will that mean for safe harbor plans? Not much here other than the fact that unless, if you're able to have the employer match go to a Roth, it has to be a situation where the individual is fully vested. You cannot have any amounts that are potentially forfeitable go directly from the employer into the Roth section of the plan. That's really the big potential issue, if you will. But the 143 wages, as I read this back, I note that we're kind of combining two provisions here. So the matching contributions about going into a 401k, that exists today, that exists this year, and that's one thing. The, hey, beware of wages over 145,000, that's for the catch-up contribution that an individual would make themselves, and that does start next year. So what that simply means is that if, beginning next year, if you had more than $145,000 of wages this year, you can only make your catch-up contribution to a Roth IRA for that plan. Next question here. What's the latest on RMDs for non-spouse beneficiaries post-2020? It wasn't addressed by the Secure Act. I know, I wish it was. When does the clock start? Quite simply, I can tell you for sure for 2021 and 2022, no RMDs were required during the 10-year period. Period, end of story. And I can tell you for sure that 2022 going forward, if someone inherits from someone who died before their required beginning date, in other words, the owner had not started to take RMDs yet, the beneficiary will not have RMDs during the 10-year rule. What I can't tell you, unfortunately, is what the rules will be for 2023 going forward for an individual who inherited from someone who died after their required beginning date, who was taking RMDs. The IRS last year, late last year, came out with guidance in its notice. This is the notice if you want to write it down and look it up. It's called Notice 2022-53. And that notice said we won't impose RMDs for 2021 and 22, but it didn't say with any certainty what it would be doing for 2023. It just said the final regulations, which we don't have yet, won't apply until at earliest 2023, but it didn't say for sure this year, and we don't have them yet. So wait and see, I guess. Does Jeff feel that Roth distributions may be subject to taxation at some point in the future? Congress is getting their money now, so they love Roth contributions now, but what will they do in the future when they need tax dollars? It's a great question. I don't think they will tax Roth distributions in the future for a lot of reasons. First off, I think you'd have a constitutional challenge into and how that would work. Notably, whenever they change retirement rules, they typically grandfather people in. There's lots of exceptions in the law for certain things that you probably have never heard of, like pre-74 capital, 1974 capital gains elections, or the old money exception for 403Bs. These things are grandfathered in for people, and they don't really apply much anymore now because people have aged out. If they ever made a change, I think it would be prospective only. But think about it. If they did it, it would kill the benefit for anybody else doing it. So no one else would ever make Roth conversions again if they did something like that. So I don't see it happening. For the 529 Roth conversion, are we able to rename the beneficiary to the parent's owner? Again, the answer is it appears so. Here's another one. I have 529 over 15 years old. Can I change the beneficiary? Another question, same thing. The answer appears to be yes. If you change the beneficiary, again, we're going to have to wait for final, some sort of guidance from the IRS. But the answer appears to be if the account existed for more than 15 years, yes, you can split it and get it to whatever beneficiaries you want. How are RMDs going to be calculated for those in the 10-year rule? We just addressed that one. So lots of similar questions here. Spousal beneficiaries on inherited IRAs had some legislative changes, but they seem no different from what already existed. Okay, so the big difference is before, and actually now, because the change doesn't happen through next year, before you could take the decedent's money and put it into your own as the survivor. So you could make their money look like your money. Now what you can do is make you look like them. That's the big difference. For RMD purposes, you can jump into their shoes before you were able to make their money jump into your shoes. Hopefully that helps to clarify that. Address the impact of 401k changes to the solo 401k plan for Schedule C and S Corporation single business owners. I mean, it's always hard to summarize all changes for a group, but I'll say I think there are some difference here between Schedule C and S Corp single biz owners. Notably, S Corporation single biz owners do pay themselves a salary. They do have wages. So I think that limitation on catch-up contributions may end up applying to them. Whereas even though they have no statutory employees, they pay themselves wages. Schedule C and partners don't pay themselves wages. And so I don't think the catch-up contributions rule will apply for them. Jeff, where do you personally source the actual text when you're reviewing changes to the tax code? Literally the legislation, right to Congress's website, to the committee websites, and start from there. And then I literally read everything I can get my hands on for a while. How will the employer Roth contributions be taxed? Will the employee get a 1099 that includes the Roth contribution? Remains to be seen. It's very possible that they will just include this in the taxable wages that are not subject to FICA. There are other things like that as well. I saw that the 529 plan rollover is capped at the annual contribution limit. Does that beneficiary and Roth IRA owner need earned income? It does appear the answer to that is yes. Does the 529 to Roth provision apply to both prepaid 529 and investment 529 plans? Yeah, it says 529 in the law effectively. So anything organized under 529, which both of those are, should be eligible. Are they changing mortality or life expectancy tables? No, not yet. Eventually they will again, like they did last year, but no, nothing right now. How does the IRS expect the average investor that doesn't work with an advisor calculate their inherited IRA RMD? Will the custodians eventually be required to calculate that for clients? The first part, how do they expect them to do it? I have no idea. I will tell you that a lot of advisors, a lot of tax professionals I talk with don't really know how to calculate the RMDs, right? Let alone individuals themselves. Will custodians be required to do it eventually? I highly doubt so, because I highly doubt it. Custodians will spend a lot of money lobbying against being required to do things like that because of the liability. And frankly, even if they had the information like the client's age and date of birth, they would need money like when, or information like when the decedent died to be able to calculate that. I see Chris coming on here, so I know my time is beginning to run out. We'll go rapid fire here for a few more questions. Could you please review the comment you made about rolling 401k assets to a Roth IRA? If Roth 401k assets go to a Roth IRA, then the 5-year rule clock resets. But if it goes to a Roth IRA that has been in existence for 5 years, there is no reset of the 5-year rule. So the easiest way to say this is once Roth 401k money goes to a Roth IRA, the Roth IRA 5-year rule trumps. That's what matters. So whether you had the money in the Roth 401k for 5 years or 10 years or 100 years or 5 days, if it goes into a Roth IRA and there was more than 5 years for Roth IRA money, that plan money now gets the Roth 5-year clock. Just to make sure I'm clear on solo 401k retroactive contributions, is this only applicable for new solo plans, or does it require plus the bar? It's for new plans for the first year that they are adopted. The tax credit for employer contributions is unclear to me regarding the $1,000 per participant. Can you please clarify? So there is the startup credit, and then there's going to be an additional startup credit that you can take up to $1,000 of employer contributions per eligible employee, so non-highly comped individuals, and run that through a percentage grid, if you will. So year 1 is 100%, year 2 is 75, year 3 is 50, year 4 is 25. So let's say I had 7 employees who are non-highly comped, and I put $10,000 of profit sharing into each of their accounts for the year, or 10,000 in matches, whatever you want to call it, but 10,000 employer contributions. Well, I'm capped at $1,000 per person that I can use. So I have 7 employees, $1,000 each, that's $7,000. I multiply that $7,000 by the percentage for the applicable year. So year 1 is 100%. So I'd get a $7,000 tax credit for putting that in. That's on top of the regular startup credit. Will the factors that calculate RMDs be adjusted for the IRS table? No, they will not. You're just going to knock off age 72 and start at the age 73. And in a few years, you'll knock off age 73 and 74 and start at age 75. And last one, will an employer receive a tax deduction for making Roth contributions on behalf of employees? Yup. It's just the employee telling the employer, instead of taking the money you were going to give me in my traditional account, put it in a Roth account instead and tell the IRS I owe them the money, the tax on that this year, as if I had made a Roth conversion. I know there are lots of questions. I actually can't believe how many questions we had left. I thank you all for your participation in this. I will try and work with Roger and Chris on trying to get you more answers. I think I see a lot of these questions. We did answer a lot of them. I do have to answer one more though, Chris. Question here, are you really a Pittsburgh Steelers fan? The answer is, of course. I spend my life making sure that, I want to always be associated with the right things. And there's nothing more right in this world than the Pittsburgh Steelers, my friends. So thank you for that question. On that note, Chris, I will turn it back to you. But thank you all for joining us, and have a wonderful, happy, healthy, and prosperous start to the new year. Chris?
Yeah, Jeff, thank you so much. And again, thank you to everybody who hung with us for those 90 minutes. If it makes you feel any better, Jeff hung through 4,100 pages of the Secure Act. So we're in great territory here among legends when it comes to being able to endure lots of tax talk. So we will send out Jeff's slides and a video of today's presentation to everybody who was registered. I know that was a very popular question as we went. And just for our subscribers, we will record every webinar we ever do with almost no exception. So you can just rest assured that that's pretty much going to happen 99.999% of the time. And you can just breathe and rest easy knowing we got you taken care of. So we will send Jeff slides. We will send a video of this recording to everybody. A huge thanks to Jeff. Again, thanks to Roger and the dev team for getting that stuff coded in. No small task. And if you're not a subscriber yet and you want to try the software, you can do a 7-day free trial where you can upload up to 3 returns and test the software out. So we'd love for you to do that. You can just go to holistiplan.com. Most firms are starting at $1,000 per year, which gives you up to 75 uploads, and that's for unlimited users in your firm. So we don't charge per advisor, we charge per firm. So that's the starting place. For most people, I think 80% of it, people who signed up last month started at the $9.99 a year plan. And we'd love to have you on, and you have time now. We're going to start a special program with Jeff's great friend, Debbie Taylor. And on January 19th, Debbie Taylor is going to start a masterclass that we're offering to all of our subscribers. And she's going to do 1 session every month for the entire year, basically walking you through, if you've never done much tax planning, how would you get to the end of the year and feel confident and competent? And Jeff can tell you there are very few with Debbie's energy and sincere love for teaching. So really excited to work with her, and especially for our subscribers, new subscribers who maybe haven't done much tax planning in their firms so far. So, okay, you guys are awesome. Jeff, thanks again. And we'll get these slides and video to everybody. And you guys have an awesome rest of the week. We'll talk soon. Thanks. Bye-bye.